we have been very pleased to have regular updates from Dr. Kaushik Dev, who is with BP, he's an economist with BP, on really updating us on what BP is thinking in terms of the last year in energy. Occasionally Kaushik is presented on their 2035 projections, and this is just a very nice opportunity to have somebody thoughtful and very experienced in the world of energy take us through the debates of the last year, backed by some hard analysis and data. And it's really meant to be an informal conversation between those of us in the room. Some of our usual regulars to these conversations have expressed their apologies. They can't be here. They're traveling for one reason or another. But we have many other people in the room who are more than capable of sustaining the conversation. So let me briefly introduce Kaushik. Dr. Kaushik Dev is with BP in India. He's an economist. And before BP, Kaushik was a director at IBFC, which is when we met. Kaushik, we are very happy to have you back here again and look forward to your presentation.
Thanks, Navroz. Thank you everyone for turning up on this rather muggy Friday afternoon. I'm hoping that this is a good beginning to the weekend and everyone does enjoy the presentation as much as we did sweating the data. Some of you may be familiar with the statistical review, but for those who are seeing this for the first time, at the most basic level, this is an Excel file that we put up on our website. This Excel file includes data for energy consumption, production, trade for almost every country in the world, and in some cases our data series go back 100 odd years. In parallel to this data set, what we also do is write out a narrative of the past year. A narrative in the context of seeing what has changed significantly and what possibly have the implications for the future become more significant or so. This is a data set that comes out, this is the first data set in the world of energy that comes out every year and is reasonably widely used and commented on and analyzed as well. But the whole idea of putting this out in public and making this available is basically that we sweat the data so that you guys don't have to. 2014 was a remarkable year in several many ways, and all of us who follow the world of energy were rather surprised about the turn of events. Some of you who were there in my presentation last year during the Statistical Review 2013 would remember that we had this slide where we talked of oil prices having been the most stable that they have ever been since 1970. As a statistical measure, the volatility in oil price was the lowest since 1970. And remember, before 1970 we really had not a liquid market, as it were. We only had official selling prices of the Saudis and the UAEs and the Kuwaits of the world. And what a change did 2014 bring. The US shale revolution scaled new heights, prices of oil fell through the floor, and carbon emissions have essentially stagnated. Let me take you through the narrative for 2014, but first identifying the three, and I did something wonderful. I probably ended much faster than I thought. The three key forces that have seemed to driven the 2014 story. If 2014 was the year of the horse in China, in the world of energy, it was the year of the American eagle. At its peak, the US shale revolution commanded 1,800 rigs. They were drilling nearly 40,000 wells. Capital expenditure had gone up by 50% within a 5-year period to 120 billion in the shale industry. This is a remarkable increase of industry in this size anywhere in the world. To give you a sense, compared to the 1,800 wells that were operating in October 2014 in the US, the second highest number of rigs that were operational anywhere in the world was in China, and they were just about 800 odd. What is the impact? US oil production last year increased by 1.6 million barrels. This is the biggest increase in any country in 2014. In fact, this is the first time that the US overtook Russia as well as the Saudis, an increase in oil production. The last time this happened was 1975. The US also bettered its own record in oil production that it last set in 1970. So much for peak oil. And you have the same story being replicated in the case of natural gas as well. Thanks. 80% of the increase in natural gas production last year came from the US. In fact, over the last 10-year period, about 50% of the increase in world's gas production has come from the US. In the revision in the data set that we've had to make for 2013, US has already overtaken Russia as the largest producer of gas and oil combined. We are truly witnessing a change of guard in the world of energy. But while the American eagle soared to new heights, the Chinese horse quickened its pace of adjustment. We are used to seeing double-digit growth rates in GDP come from China. Last year, the growth rate declined a bit further, down to about 7%. A large measure of this decline is a structural change in the Chinese economy. As services become a larger part of GDP, this is now a structural thing that's been built into the Chinese economy, a second year running that services are a larger part of GDP than industry, their energy intensity declines. But very significantly last year, all the energy intensive sectors of the economy, real estate, steel, iron, cement, had growth rates that pretty much went through the floor. They simply went through probably one of the worst crashes that they have seen since the financial crisis of 2008 or so. The impact of all of this was the fact that Chinese energy consumption increased by just about 2.5% last year, well below the 6.5% 10-year average that we've seen. This is a remarkable and significant decline in energy consumption growth. But this also implied that Chinese energy intensity declined by 4.5% last year, which again is a fairly large number. Significant? Yes. Remarkable? Yes. But unprecedented? No. China has achieved similar or larger declines in energy intensity in the past as well. And more generally, as Chinese energy intensity becomes closer to, say, a US or the OECD world, our characterization of the developed world, the likelihood that energy intensity improvements moderate is higher. The structural change that happened in the Chinese economy will continue to push energy intensity down, but some of these one-off shocks, especially in some of the energy intensive sectors like real estate, could perhaps be reversed as we go forward. The third key feature of 2014 has been the fact that climate change has come back to the table as public discourse. As we approach the Conference of Parties in Paris later this year, this is a topic that increasingly demands attention from governments and also from companies. But it's also kind of important to remember that the story around climate change and the discourse around climate change is not independent of energy. It's not that we will be able to reduce or manage carbon emissions because we will run out of energy. Our oil and gas reserves in 2014 were twice as high as they were in 1980. So with all the extraction that's taken place in the last 35 odd years, with all the growth in consumption that's taken place in the last 35 odd years, we still have a lot more oil and gas under the ground today than we did 30 years back. So the issue is not whether we are going to run out of energy, but really how we are going to consume it in a much more sensible and sustainable manner. The big macro feature for 2014, with the slowdown in Chinese energy consumption, global energy consumption slowed down quite considerably. In fact, barring the financial crisis, this is the slowest growth in energy consumption that we've seen since the late 90s. A growth of energy consumption by less than 1%. But very interestingly, this growth in energy consumption of less than 1% took place in a world where GDP growth was almost on par of what it was last year. below its 10-year average, but similar levels of GDP growth that we saw last year. The net outcome is an improvement in energy intensity, and an improvement in energy intensity which is significant enough to take us back to improvements that we've seen 10 years back. The second trend that comes out from the data from the macro data from last year is this. If we look at this concept of imbalance, this idea of a difference between supply and demand for each geography, and we look at this for OECD and the non-OECD world, the imbalance has increased for the non-OECD and has declined for the OECD world. In fact, 80% of the increase in supplies last year came from the OECD world. This is mostly a reflection of the shale revolution, but it also gives you a sense of where energy is being produced and where does it need to go. So, a harbinger of trade flows. Oil, still the most important energy market of all. And oil was pretty much at the epicenter of the storm last year. And make no mistake, the story of oil last year is really one of oil supply, because oil consumption change last year was pretty much on par with what we've seen for the last 10 odd years. Most of the growth in oil consumption, all the growth in oil consumption comes from the non-OECD world. OECD oil consumption peaked in 2005 odd and has been in structural decline since. The growth in non-OECD oil consumption last year, the biggest contributor was China. Chinese oil consumption increased by about 400 odd kilobarrels. The second biggest increase came from countries like India. The biggest declines coming from the OECD world, Japan and the European Union. US is that one rare example in the OECD category which had an increase in oil consumption. They had a fairly severe winter in 2014, and the fact that prices at the pump eventually went down, allowing US consumers to buy more cars and drive more miles. So the increase in US oil consumption is a reflection of that. But very interestingly, that's also the story of the increase in Chinese oil consumption. The Chinese oil consumption increase is mostly comprised of increase in gasoline demand, not in middle distillates. Middle distillate demand growth pretty much slowed down on the back of industrial slowdown in China. But Chinese consumers having higher per capita incomes, being able to buy more cars and driving more miles, consumed a lot more gasoline. And that's a trend that's likely to continue again. But the other side of the picture, I think, is a lot more significant. The increase in oil production pretty much beat almost all past records. The increase of oil production of nearly 2 million barrels a day. Now, this is in large measure the US story, 1.6 million barrels coming from the US. But there are several other non-OPEC oil suppliers which are doing very, very well. Russia, Canada, Brazil, all of them are operating at post-Soviet high, post-crisis highs and record highs in their history. OPEC, interestingly, despite everything that happened last year, pretty much maintained its production level of 30 million barrels. They had a slight decline, very marginal, which means that all the increases that we saw coming in from the Saudi Arabias of the world and Iraqs of the world were being offset by declines and continued declines in Libya and in Iran. Ask any economist what happens when there is such a large difference between production and consumption, and the answer usually is inventories. The year started last year with inventory levels at very low levels. These were at the lower band of a 5-year average, as it were. But as production continued to rise faster than consumption during the course of the year, inventories continued to build. And by the middle of the year, by about July odd, we were at the middle of this band. July, when I came here and made the stats review presentation, the price of oil was still $109 a barrel. But the market did recognize that this is not a balance. And the price of oil started to creep down to about $80 odd a barrel. The last time in history when the price of oil fell during the financial crisis, OPEC cut back production and helped prices recover. Every energy analyst, every oil and gas analyst thought that OPEC would do the same. And when they did not do that in November, the price of oil pretty much went through the floor, crashing to about $40 odd at the beginning of January. As oil and gas economists, we kind of always think that we are a bit special, that normal laws of supply and demand and prices don't apply to us. But this is a perfect example to show that prices do work even in the oil market. When the price of oil was high, the $100 odd that you saw for 3 years running, allowed for innovation and growth in a fairly difficult and complex market such as US shale. As US tight oil production continued to increase, they exploited economies of scale. There was learning by doing. The productivity increases were 35% year on year. The net outcome was a vast increase in oil production there. And the price of oil fell. And we would now expect a similarly strong demand reaction to the low oil prices. Now, when you have such large volumes of stock, how do you deal with that? You ask the refining industry to process that stock and get it to the market as quickly as possible. So the story here becomes that you ask refinery runs to increase, and refining runs increased by more than twice as much of the 10-year average. Now, where would refinery runs increase the most? With people having the largest volumes of stock, i.e. the Americans. American crude stock levels are as high today as they were in 1930, and that's when the demand for oil had pretty much crashed on the back of the Great Depression. The same thing that we see in the Chaplin films. Let me give you a sense of what happened in the gas markets last year. Gas has been one of the faster growing fossil fuels, and this is the fastest growing fossil fuel in our forecast as well. But last year was not a great year for gas. Gas consumption grew by only 0.4%. Most of this decline in growth in gas consumption came about because of slower growth in the European Union. European demand collapsed to about 11.5%. I don't know how many of you spent your summer in Europe last year, but apparently they say that it was milder summer and hence their gas demand was lower. But gas production continued to increase rapidly last year. With 0.4% increase in gas consumption, gas production increased by 1.6%. With such a large supply overhang again in this energy market, the prices collapsed. Especially in our part of the world, especially in Asia Pacific. We'd become accustomed to paying a premium of about $10-12 over the European price of gas to be able to attract gas to come to our market. That pretty much changed last year. From a premium of about $20 in January last year, $12 in January last year, the premium has collapsed to about 50 cents this year. So Asian consumers no longer have to pay a larger price to be able to attract this gas to come to our markets. That is a story of gas trade. Overall gas trade declined only for the second time that we have data for, the second time that we have records for. Most of this decline in gas trade came from a decline in gas pipeline trade. As European consumption fell, they imported less gas from Russia, i.e. Russian supplies into Europe fell last year. Added to that, the fact that Russia did not supply because of the friendly relationship with Ukraine for about 5 months last year. Net pipeline trade last year fell by about 6%. But the form of trade that's much more significant and important for our part of the world, i.e. LNG, that had a good year after 3 years of stagnation. LNG supplies are now starting to come back to the market. There was an increase of about 8 BCM from Papua New Guinea last year. And this is something that will continue as new Australian supplies continue to come to the market. So as gas supplies in the form of LNG continue to increase, that allows for economies in our part of the world to be able to import gas at a much more reasonable price perhaps, especially as the market would probably end up in a supply glut over the next 5 odd years or so.
Sorry, Kaushik, just to clarify, so the decrease in Asian gas prices is due to various causes of increase in supply of LNG from sources such as Papua New Guinea. That's the bottom line.
Starting with Papua New Guinea, but now continuing with Australia. I mean, that one straight simple answer. There's also a story around gas consumption slowing down in economies such as Japan and Korea, but those were anyway one-off shocks. The structural increase in gas demand that we would expect to see come from India or China would eventually absorb the supply, but the increase in supply right now outstrips the increase in demand. But you can never tell the gas story without talking about the US. If you look at this picture for the last 10 odd years and you look at the blue and the green parts of the bar, you see how much has the US domination of the gas market increased. From almost nothing 10 years back, everything in the gas market now comes from the US. And within that, the increase in this green portion, the increase in US shale has been so much more remarkable. The entire gas market is dominated by increase in US shale. This increase in production has also allowed US to increase its gas consumption, as also be able to push out coal from electricity generation. In fact, there was something in the FT earlier this week that said that gas has for the first time overtaken coal in the US electricity market. Yet to check that data, but that was something that one would expect as being normal now. Right. Something that I suppose is much more closer and relevant to our part of the world. The story of coal is the story of China. China is coal, coal is China. There is no way that one kind of talks about coal without dealing with China. And last year, Chinese coal consumption was pretty much flat. In our estimates, it increased by just 0.1%. Given the fact that Chinese industrialization has mostly been driven by consumption of coal, and coal consumption over the last 10 odd years has on an average increased by about 6 odd %, this is a considerable slowdown. As a result, global coal consumption came down to just 0.4%. Coal production in China, on the other hand, fell, and very significantly by 2.5%. This brought down the global coal consumption down by 0.7%. Why did the Chinese coal consumption fall? From last year's 2.2 odd % to 0.1% today, the difference is explained in most measures by about 2/3 by the fact that slower energy consumption growth, because of the economy slowing down, because of the energy intensive sector slowing down. But a third of this slowdown in coal consumption growth is because gas is being crowded out by hydro. Hydro had a remarkable year in China, increase of 15%, gas and renewables. So loss of market share to non-fossil fuels and gas. Now what's the one bright spot in the coal market? Guesses? India. India's coal consumption increased by 11 odd % last year. Coal production increased by 6.5%. These are the largest volumetric increases in consumption and production that we have records for. It's just a one-year performance. This allowed India's electricity generation to increase by about 10 odd %. India's reported peak deficit came down to just about 2 to 3% last year. But there is a difference between 6.5% production growth and 11% consumption growth. And this difference is 20% increase in imports. So all of the Indonesian coal that was finding its way to China earlier now finds a ready market in India.
I can just clarify, these are calendar years. You're giving
Calendar years.
So you're seeing production 6.5%, consumption 11.5%, import 20%.
21 point something. In fact, you'll have the exact numbers in an India fact sheet that we put up on our website, and you could just use those numbers as well. But one of the biggest stories also for 2014 is the fact that this is the first year on record that we have data for, and I'm sure this is the first time in the history of the world, that non-fossil fuels have contributed more to energy supply than fossil fuels. So renewables, hydro, nuclear added more to energy than coal, oil and gas have ever did last year. This is really unprecedented, and this is really remarkable. The increase in hydro production mostly came from China. It was offset by some declines due to droughts and weather-related events in Brazil, etc. Nuclear finally is having another renaissance, as it were, with coming back to on stream in Korea and possibly this year in Japan, and new power plants being commissioned in China. But one of the more interesting stories here is one of renewables. The renewables contributed to about 60% of the increase in electricity generation last year. The biggest increase, the biggest amongst all fossil fuels. This is a growth in renewables of 12.5%, which is brilliant performance. But as always with the renewables, this is a story of glass half full, half empty. 12% growth rate in any sector and any metric is brilliant. It's fantastic. If my salary goes up by 12% every year, I'll be very happy in life. But this 12% is a significant decline from what we've seen 3 years back. 3 years back, renewables were growing at 20%. Now, to the extent that this decline in growth rate is because of a larger base, one understands this decline in growth rate, that the growth rate moderates as the economy and that sector and that activity becomes bigger. But as you dig deeper, you realize that the slowdown in renewables is most pronounced in economies where the share of renewables is the highest, Germany and Spain. So what's happening? Well, the fact that renewables growth in these economies was funded through subsidies, and growth of the sector has been faster than the GDP growth, has meant that the impact that renewable subsidies have had on their fiscal balance has continuously increased over time. And with shrinking fiscal balances in these geographies, it becomes a challenge for them to sustain these levels of growth. But again, renewables had a great year in a country like China. That's where you still have a large space to grow, and hopefully a fair amount of money still available for renewable growth to be funded.
So, just clarification, you said renewable energy contributed 60% to the increase in electricity. And that's by energy or by capacity?
By energy. These are all terawatt hours. We don't track capacity in our tables. And what does this all mean in terms of carbon emissions? Carbon emissions grew the slowest since the 1990 ends. In fact, significantly lower than their 10-year average. About half of this slowdown in carbon emissions growth is, in our estimate, because of an improvement in energy intensity. As the Chinas of the world consume less energy to produce GDP, that's something that brings down carbon emissions. About a quarter of this slowdown in growth is because of a slower GDP growth over a 10-year average. But the improvement in the fuel mix, i.e. a larger share of renewables, hydro and nuclear, have meant that it's contributed another quarter of the slowdown in carbon emissions growth. So carbon emissions in our math increased by just 0.5% last year, the slowest growth that we've seen since the late 1990s. But even more stark is when I do this by geography. The slowing energy consumption growth in China adds so much more to the slowdown in carbon emissions growth that it overwhelms almost every other contributor. And this also gives you a sense of the contribution that China, and the missing piece here, i.e. US, make to the world of energy and hence emissions. What's also missing in this picture, and I'm hoping hidden reasonably well in the 2014 bar, is that most of that comes from India. The increase in coal consumption and the slowdown in gas consumption. So, to put it all together, was 2014 an important year? Will we all look back at 2014 and try and figure what we were doing that year? Well, yes and no. Things like the US shale revolution, the slowing energy consumption due to structural economic change in China are things that will stay with us for a very long time. And these are aspects of the energy world that we need to take into account now and in the future. But some of the slowdown that we have seen in, for instance, European gas demand, and I can kind of discuss that in more detail if there is interest in the Q&A, or the slowdown that we've seen in the most energy intensive sectors in China is probably not sustainable and probably comes back to more normal levels in the years to come. But this is something that we will have to keep our eyes open to, and I suppose I'll get a chance in another year to come and speak to you about this. Thank you.